Good day to our viewers. I'm Darren August and with me is Jolly Mohorosi. This discussion is brought to you by the Association for Savings and Investment South Africa Foundation. We're going to have a discussion on retirement funds and how retirement funds relate to one being financially resilient. I'm a facilitator on a few of the consumer financial education programs that are conducted by the ASISA Foundation, and Jolly is one of our retirement fund trustee education lecturers. She also serves as an independent trustee and is an executive principal officer on a few retirement fund boards. She's also the program champion for the ASISA Academy's Consumer Financial Education Practitioner Program. What a beautiful CV, Jolly. Welcome and thank you so much for joining us.
Hello, Darren, and hello to your viewers.
Jolly, so when we talk about retirement funds and how these relate to being financially resilient, please let us know what this means for me and our viewers who are members of retirement funds.
So, Darren, to enjoy financial resilience from your retirement savings in your retirement funds is being able to live a life during retirement that financially compares well to how one lived before going on retirement. Just to be clear, when I say retirement fund, I'm referring to pension, provident, preservation, and retirement annuity funds. So those funds recognized by SARS as vehicles for savings for retirement, and they therefore receive tax benefits now and when you retire. Pension funds and provident funds are offered by employers, whereas preservation funds and retirement annuities tend to be products offered by insurers that you take in your personal capacity. So the major difference in these lies in when you access your money, how you access your money, and how much tax do you pay and when.
Thank you for that. That is certainly a need that we all have, but especially so during these challenging times. There has been a lot of talk about the retirement fund reforms that came into law from the 1st of March this year. What's that all about?
Darren, I think the industry has had a good look at the outcomes of the last decade or two and realized that we're not seeing the resilience we would like to, with stats showing that only between 3 and 8% of retirees being able to live a decent post-retirement life that is comparable with their pre-retirement lifestyle. With this in mind, there have been a number of changes over the last few years. These changes that took place on the 1st of March were announced actually in 2017. So the industry has had some time to adjust to them. They are part of a bigger plan to treat all retirement funds the same, meaning pension, provident funds, and retirement annuity products should not be as glaringly different as they have been in the past, and give more South Africans greater and more equitable access to benefits of retirement. The changes that came into effect on the 1st of March apply to provident funds. The biggest change is that from 1 March 2021, when you leave your fund, your provident funds and pension funds will be treated the same. The exception is if you are 55 or older and you retire from the fund you currently contribute to.
Right, but if you're not older than 55, what happens to the retirement savings?
Well, if you're not older than 55, your retirement savings will basically be divided into two pots. One from before 1 March 2021 and the other from after this date. One pot can be called a vesting portion and the other a non-vesting portion, meaning all the rights you had before 1 March 2021 will remain or vest. Then new rights, obligations, and laws will apply to the portion after this date. You should be able to see this clearly in your member benefit statement if you are a Provident Fund member. The major differences between pension and Provident funds are being eliminated through a series of laws. Through these changes, Provident Fund members may be encouraged to save for retirement and experience the same benefits as pension fund members.
All right, so what kind of differences are we expecting to see, Jolly?
So one of these changes, for instance, is the requirement to buy an annuity, which is simply a product that gives you a regular income stream from your retirement savings. In the past, pension fund members were required to purchase an annuity and provident fund members were not, and could on withdrawal receive a cash lump sum, which sometimes runs out as people tend to live longer after retirement than they expect to.
Longevity is actually not something that gets enough airtime.
Hmm. I don't know about you, but quite a few of my relatives are making it to the 90-year mark, and we are fully expecting a few 100-year-olds. Let me put the implications differently. During my time in financial services, I've seen the life expectancy of the average South African increase by about 10 years. That means that the average South African has 120 more months in retirement than when I started in the industry. This is largely thanks to medical advancements and a better understanding of contributors to greater life expectancy, as well as a general improvement in living standards. The thinking is that annuitization will lead to bigger savings and more desirable retirement outcomes. I'm sure you'll agree that that means better financial resilience during retirement.
Absolutely. So, on the subject of financial resilience, death is never a comfortable topic, but we cannot get away from
Mm.
it if one is truly doing financial planning holistically. From a retirement fund perspective, what are the issues that trustees of retirement funds see that affect members of retirement funds?
So the death of a member, especially if the deceased is a family's breadwinner, typically puts serious strain on a family's ability to survive financially. Such a stressful and emotional environment is not always the best for making major financial decisions. One of the biggest challenges that trustees have to deal with, and that challenges opportunities for financial resilience, relates to beneficiary nomination forms. For instance, most beneficiary nomination forms will ask members to list all their dependents, but not all members ensure that their beneficiary nomination forms remain up to date or are even fully completed with details like dates of birth, ID numbers of nominated beneficiaries. Some will only list their spouse or people that they live with, and not everyone who depends on them for financial well being. For example, my mother in the rural areas, whom I send money to every month. This is a mistake and it makes it difficult for the trustees. These omissions often result in a delay in payment of any claims, as trustees are then obliged to investigate who the real beneficiaries are, especially in cases where people are not mentioned on the nomination form, but then come forward to make a claim. When such instances must be dealt with, your monies will not be paid as speedily to your beneficiaries and costs increase. The law allows trustees to take up to 12 months, but if everything is in order, this process can take as it can take a much shorter period. So really, if families do not have the savings to see them through, this period becomes very difficult to live at the standard you are accustomed to. Something we also see is families struggling to produce documentation, be it bank account statements, proof of address, IDs, marriage certificate, birth certificates. So the type of documents funds need to FICA a person. These are surprisingly difficult to get in some instances. Keeping these documents in a place that is easily accessible for your family and teaching the elderly or children how to do some of these things helps them function better in a modern world. We have seen sad cases of children ending up on streets, children being pulled out of good schools, and families even starving. Families therefore need to plan for different scenarios so that they are not caught off guard financially. Many employers, some banks, some retirement funds offer the services of financial planners in addition to all funds having retirement benefits counseling. Members can approach their HR, retirement fund, bank, or insurer to find out more.
Are you implying that I cannot tell the trustees who to give money to and they will do just that?
Yes and no. The trustees do need the information you put in your nomination form. The more complete this is, the quicker a benefit can be paid out. But the law expects trustees to do a full investigation of the financial and emotional dependency of your loved ones around the time of your death and make an equitable distribution. So, if you nominate your cat to receive your full benefit while you have family members who depend on you financially, or you have a young child you left out of the nomination, trustees can then override that nomination. This is different from a will that you have for your estate. In your personal estate, you have the freedom of testation. This is not the case in retirement funds.
Cannot imagine anybody leaving their money to a cat. But if I owe money, can this be deducted from my pension?
The short answer is no, but yes. Your retirement benefit is protected from debt.
So my Maserati, is that safe?
Okay, but there are exceptions. Your employer can seek a deduction from your retirement fund on account of loss that they experienced through an act of dishonesty, fraud, or damage caused by you. The employer will need to prove this through a signed admission of guilt or lodging a case and proving this through a judgment, a court judgment. So, say you owe a major retailer money and they're looking for ways of claiming that money from your retirement benefit, they cannot. The other exception is if you took out a loan, a home loan, and your retirement benefit was used as guarantee with the bank for this home loan. If you fail to make the bond payments, the bank may seek payment of the outstanding amounts from your retirement fund. If you had failed to arrange with the bank before death or exit. Lastly, if you have outstanding tax or if you have outstanding child or spouse maintenance orders, or you have divorced and the retirement benefit forms part of the divorce settlement, these can all be deducted. So one way in which members can foster financial resilience is through remaining on top of their tax affairs and making alternative arrangements before retirement funds get involved out of legal obligation.
So what are boards of trustees doing to ensure that members are more financially resilient?
One way is most funds allow what we call an additional voluntary contribution, or AVC. This allows a member to contribute more than the minimum requirement. So members can take advantage of institutional rates, making this a cheaper savings option. Retirement funds have introduced what is also called retirement benefits counseling. I mentioned this earlier, but I didn't really expand on it. Funds are approaching it differently, but for the most part, members are given retirement benefits counseling through access to a person who can help them understand their options via email, telephone, or physically. Some funds are even approaching this actively and contacting members close to retirement to make them aware of their options. This meets a requirement of the law and is another way that financial resilience is being built into the new retirement framework.
So should financial resilience not ultimately be the responsibility of the member?
You are right. Whether it is ensuring your tax affairs are in order so that you don't have a tax liability that stops you from exiting the fund. I've unfortunately seen this during my time as principal officer, or understanding your financial affairs and having a clear understanding of where you stand. I once paid a member, and because he could not read his bank statement, he did not know, and ended up pawning his precious prize kettle to survive. So for 18 months, this money sat in his account. Imagine all the missed opportunities, the stress suffered. In another instance, a member organized a strike at my office because, again, he believed he was not paid. I checked the system and I helped him obtain a bank statement and then showed him how to read the debits and the credits on his account. He was elated. Ensure you know how to read and understand your financial documents. Ask for help so that you are in a position to be in full control of your financial future.
Charlie, thank you so much for helping us understand this better. I see there are a number of things we can all be more vigilant about. I think on my part, my nugget is I'll regularly check my nomination form to ensure that everything is up to date. If I'm unsure of anything that may impact on my retirement or my beneficiaries, I'll consult with my employer and my financial advisor. Thank you so much for listening to Jolly and me discuss this very important topic related to us being able to enjoy a comfortable retirement. Remember, viewers, for more information on this topic, please visit the website that is indicated on the screen. Thank you for joining us.